February 26, 2022. One administrative decision. $300 billion in Russian sovereign reserves. Frozen, not seized, not destroyed. Frozen, inaccessible, suspended inside the financial infrastructure of countries that had just become adversaries. No missile fired, no soldier deployed, no declaration of war in any conventional sense. One instruction transmitted through the messaging system connecting Western central banks, and the reserves simply stopped being usable. This is not about Russia. Not about whether the freeze was justified. This is about the calculation that ran automatically, within days, inside the finance ministries and central bank risk committees of every other nation on Earth that held dollar-denominated reserves. The calculation was not ideological. It was technical. If $300 billion in reserves can be immobilized by a coordinated administrative decision, then reserves are not reserves in the traditional sense. They are conditional holdings, and the largest single category of conditional holding in the global financial system is the US Treasury bond. This video does not analyze policy, does not debate who is right or wrong. It only dissects one mechanism. The mechanism through which $8.5 trillion in foreign-held U.S. debt became, simultaneously, the foundation of American financial power and its most structurally exposed vulnerability. And once a mechanism of that scale is understood, the question shifts from whether it can be used to who has already begun using it. When $36 trillion in outstanding obligations requires continuous foreign capital to roll over, when the nations supplying that capital have just watched $300 billion in peer reserves disappear, the decision made at the next Treasury auction is no longer purely financial. It is a calculation about conditional trust. And conditional trust has a price, denominated in yield. To understand why February 2022 changed the calculation, it is necessary to understand what was built before it. In 1944, at Bretton Woods, New Hampshire, representatives of 44 nations agreed to anchor the post-war global monetary order to the US dollar, itself convertible to gold at $35 per troy ounce. Oil would be priced in dollars. Commodities settled in dollars. Cross-border debt denominated in dollars. The instrument through which foreign governments held dollar reserves safely was the US Treasury bond, a direct obligation of the U.S. government, liquid and, until February 2022, considered unconditionally accessible to its holder. The system compounded for 80 years. By 1980, foreign governments held approximately $200 billion in U.S. treasuries. By 2000, $1 trillion. By 2013, $6 trillion. By 2024, $8.5 trillion. 25% of the total $36 trillion outstanding. The mechanism producing this accumulation was structurally automatic. Countries sold goods to U.S. consumers, received dollars, and needed somewhere to hold those dollars that was liquid enough to use, safe enough to trust, and large enough to absorb billions in annual placement without distorting prices. No other instrument qualified. The European sovereign bond market, fragmented across 20 separate fiscal jurisdictions, totaled approximately $11 trillion, but without unified backing, no single European bond could serve as a reserve asset at scale. China's renminbi accounted for 2.8% of global foreign exchange reserves by 2024, against 58% for the dollar. So the dollars flowed back into treasuries. Japan recycled approximately $70 billion per year. China, at its peak in June 2013, had accumulated $1.317 trillion, the largest foreign sovereign position in U.S. government debt ever recorded. The United Kingdom held $740 billion. The top 6 foreign holders combined for $0.2 trillion. None of these positions were strategic choices made in a single room on a single day. They were the structural residue of decades of trade flows, priced in dollars, with no alternative of equivalent depth. The accumulation was, from the perspective of each individual holder, the rational outcome of operating inside a dollar-denominated global system. What February 2022 did was not create a new fact. It revealed the conditionality clause that had always existed in the fine print no one had needed to read. Every year, a portion of outstanding treasuries mature. The U.S. government issues new bonds to replace them. This rollover cycle is not optional. It is the operational heartbeat of the $36 trillion debt structure. Between $3 and $5 trillion in treasuries required refinancing each year under normal conditions. By 2024, that figure had shifted materially. Approximately 31% of outstanding treasury debt, roughly $11 trillion, was set to mature within 12 months, requiring replacement at whatever yield the next auction cleared. The yield is set by the buyers. From 2010 to 2021, the 10-year Treasury yield averaged 2.1%. This was the rate at which the U.S. government rolled its debt, low, stable, maintained by a buyer base that treated treasuries as risk-free. Between January 2022 and October 2023, that yield climbed from 1.5% to 5.0%, a 3.5 percentage point increase. Each percentage point of sustained yield increase on new issuance adds approximately $360 billion annually to the federal government's interest bill. The Congressional Budget Office, under assumptions of stable foreign demand, projects annual interest payments reaching $1.6 trillion by 2034, exceeding the entire current U.S. defense budget of $886 billion. That projection does not model what happens if foreign demand is not stable. The mechanism activates before anyone sells a single bond. When a major foreign holder signals reduced reinvestment appetite through smaller bids at auction, through public statements reclassifying U.S. assets as geopolitical risk-bearing, the auction clearing rate rises automatically to attract domestic substitutes. In early 2025, a Danish pension fund announced it would not reinvest approximately $100 million in maturing U.S. treasuries. $100 million is 0.0003% of the total market, numerically negligible. But institutional risk management does not operate on current dollar values. It operates on probability reassessment. When one institution reclassifies an asset, every comparable institution receiving the same market data runs the same model. The question propagates: are we underpricing the geopolitical risk embedded in $8.5 trillion of foreign-held conditional holdings? Nominally, the Federal Reserve can suppress this mechanism through direct bond purchases, expanding its balance sheet to absorb treasury supply and hold yields down. Between 2020 and 2022, the Fed expanded its balance sheet from $4.2 trillion to $8.9 trillion through exactly this intervention. The result: consumer price inflation reached 9.1% in June 2022, the highest since 1981. The constraint on unlimited monetization is not legal. It is structural. Dollar stability is the mechanism that makes treasuries attractive to foreign holders. Debasing the dollar to suppress treasury yields destroys the same foundation that sustains the demand the Fed is trying to substitute for. The Fed can buy time. It cannot buy the mechanism out. China's response to February 2022 was not a surprise. It was the acceleration of a process that had already been running for 9 years. In June 2013, China's treasury holdings peaked at $1.317 trillion. By December 2024, that figure stood at $759 billion. A net reduction of $558 billion, executed without a single dramatic liquidation, without triggering a market panic, and without absorbing significant losses on the exit. The method was calibrated, not a sell-off, a systematic reduction in reinvestment at each quarterly auction cycle, combined with selective open market sales timed to periods of dollar strength when bond prices were higher and losses minimized. The capital redeployed from maturing treasuries did not return to another paper instrument. Between 2022 and 2024, the People's Bank of China added 316 metric tons of gold to its reserves, bringing the total to 2,264 metric tons by mid-2024. Gold held in vaults in Beijing has one property that a treasury bond held in custodial accounts at the Federal Reserve Bank of New York does not. It cannot be frozen. The February 2022 reserve freeze did not cause China's divestment. It confirmed the logic that had been driving it since 2013 and removed any remaining institutional hesitation about the pace. Between Q1 2022 and Q4 2024, China's annual divestment rate accelerated from approximately $40 billion per year to $113 billion per year. Here is what the number means in operational terms. $113 billion per year in reduced reinvestment is $113 billion per year that the US Treasury must replace with domestic buyers at a yield high enough to clear the additional supply. Multiplied across several major holders, reducing simultaneously, not by coordination, but by the same independent calculation reaching the same conclusion, the yield pressure compounds. And compounding yield pressure on $36 trillion in outstanding obligations, 31% of which matures within 12 months, is not an abstraction. It is a specific number of basis points added to the next auction. China established the operational template. Its divestment was visible, bilateral, and explicable within an already defined geopolitical confrontation. What makes the mechanism structurally more dangerous is not what China does next. It is what Japan does. Japan is not an adversary. Japan holds $1.128 trillion, more than China ever held at its peak. And in May 2025, Japan's government issued a formal warning that should be read not as a diplomatic statement, but as a description of a technical threshold. That threshold, and the trap embedded in it, is the subject of the next video. The system does not need you to understand it in order to operate. It operates because the infrastructure is already set in concrete. The global lens.